Hello, my name is John Alexander. I'm COO and CFO of Biophysics Medical, an emerging retinal therapy technology company. I'm founder and chairman of Twin Cities Angels, an angel fund based here in the Upper Midwest, and president of Business Development Advisors, a management consulting firm specializing in providing corporate development service for emerging companies and divisions of publicly held companies. I won't read the list to you right, but to summarize, I've spent my career learning how to lead businesses and build them internally by acquisition, based on licensing technology, by investing in new technology, acquiring vertically integrated businesses and product lines. I've also created tax and other incentives to encourage investors to take risks in emerging technology companies and developing a broad array of strategic, financial, operational, and negotiation skills. This course will take about 45 minutes to complete. It's often challenging to fund an emerging medical technology company. In the last 20 years, there's been a shift of VCs to markets less risky than medtech, such as information technology and internet companies, where there's less regulation, less oversight, shorter time to market, and overall less risk. The stock market has had as much negative as positive impact on early stage investing. If it goes up, there's more potential capital to invest, but it seems less risky than an illiquid high-risk investment, which means it's difficult to get your money out. When the stock market goes up, investors are then over-allocated to the high-risk category and less capital flows in. It's tough. This being said, to paraphrase a movie, if you have value and prepare properly, they will come. While there are a range of alternatives, not every alternative is appropriate or optimal for any company, nor for any company at any particular stage of development. This course will help you develop an understanding of the different methods to fund a neurotech or medical technology startup, and develop skills necessary to identify the right funding opportunity depending on the stage of the startup, and help you develop specific funding strategies for a neurotech, medtech startup. I won't read the table of contents slide here, but this provides a range of topics this presentation will cover. So what is venture or angel capital, and why do emerging companies need it? Before going into details of what a VC is, let's talk about the evolution of businesses and why venture capital came into being and where it fits in the continuum of methods to finance a business. All businesses need some capital to go from the origin, that light bulb that goes off with the idea for the technology, the product, the business, all the way through to commercialization, which gets the product into the customer's hands. Not only does the initial creation of the idea take capital, but it takes a lot of capital to grow. At conception, just about all businesses are self-financed by the founder or the founding team. Founders usually dig deep into their own pockets to invest in their dreams. This is important. If you don't believe in your business and back it, few sophisticated investors will pony up to join you. Third parties expect this and find it curious when founders don't put their own skin in the game. Unless you have an amazing track record in creating successful startups, don't expect others to invest if you don't. This slide provides a high-level view of sources of capital. As you move down the list, generally, large amounts of funding is available, but it takes longer and requires more preparation on your part and requires satisfying more extensive due diligence by potential investors. The first tier is the founders round and includes credit cards, which are expensive, but not the worst form of financing. 18+% in annual interest is high, especially today, but this can be an important tool for time-critical needs. Famously, Fred Smith, the founder of Federal Express, paid many bills on a bunch of credit cards that he then added to over time and saved his business in the early stages. This is not without personal risk, but it's an option as it just requires the use of a credit card. Mortgages and letters of credit are less expensive, but also comes with personal risk. These usually take as short as a week for a simple LOC, or as long as a month or more if it's a true second mortgage or letter of credit. Friends and family, the first of the 3 F's. This stage may not last long, but it depends upon the founder's wherewithal, the capital needed, his risk tolerance, who else is involved, and so on. Friends and family may invest because of you. They're supportive of you and not require much time to make that decision. But few founders do not consider the impact of their relationship with friends and family capital should the company fail and the investment be worth nothing. Next comes the third F, federal funding. Federal grants change all the time and come from a range of places. The FDA, NIH, DOD, DARPA, all the letter agencies, even the IRS has them from time to time. Their terms and conditions, documentation requirements, review time, performance requirements vary significantly, but this is non-dilutive capital and worth checking out. Add to these grants for specific purposes through the Small Business Administration, the SBA, SBIR, or Small Business Innovation Research Grants for small business, STTR, Small Business Technology Transfer grants, which foster technology transfer through a cooperative relationship between small businesses and research institutions. Both are products of the SBA and designed to help startups explore their technological potential and provide incentive to profit through commercialization. Reviews of applications are only a few times a year, and amounts increase from stage to stage, but this is also not very fast. But they can be an effective way to build a non-dilutive portion of an R&D budget over a period of years. Next comes commercial lenders, or banks. Typically, banks loan against cash flow and mitigate their risk with security on some part of the company's assets. Assets are not typically found in startups, but there have been exceptions in the cases where fundable contracts exist or a founder or his family have collateralizable assets. Asset-based lenders charge higher than commercial bank interest rates and might take warrants to enhance their returns. They tend to like receivables and other liquid assets, which, in the case of default, can be sold easily so that their value tends to be discounted more, making this more expensive. Lastly comes our target audience: angels, high net worth individuals, angel funds, and venture capitalists. This will be the focus for the rest of the session, but they take more time, do extensive due diligence on your business model, definitely take equity with some rare exceptions or additions, and can take a few months or a year or more to consummate a deal. Most simply, angels and high net worth individuals, angel funds, and VCs are sources of private capital, but let's define them. Angels, also called accredited investors, are high net worth individuals whose income or net worth exceeds minimal levels as defined by the SEC, Securities and Exchange Commission. These thresholds are to assure the individuals have income, net worth, but most importantly, the experience and judgment necessary to make risky investments. This is not just a government filter, but a wise filter as you consider who to take money from. Angels invest individually and in groups. They may also invest in funds with members in leadership or with the help of dedicated or professional management. The range of processes vary as much as the range of combination of individuals. The types of groups also vary widely from just a few guys who share due diligence, this is where I started, to dinner clubs which host company CEOs, to full-fledged funds such as those we created with Twin Cities Angels. Venture capitalists are professional investors. They raise funds from others, institutions with their own capital allocation to high-risk deals, to invest in startup companies. There are layers here. The VC's objective is to invest in companies that provide an attractive return to the fund and then allow them, by virtue of demonstrating their investment success, to raise the next fund, ideally a bigger fund, which in turn means a bigger salary, bigger staff, larger deal opportunities, and a bigger piece of the action. While we are here, let's take a moment to talk about strategics, but they will be addressed in detail in a subsequent presentation. These are large, well-capitalized, publicly held companies who both invest in emerging pre-revenue companies in their space and are also potential acquirers of the company. They represent an exit opportunity. Taking investment from a strategic is complex. An investment from a strategic potentially says volumes about the attractiveness of the company, since they are both a potential customer and an exit. But, and it's a big but, how was the investment constructed? What due diligence did they do? Could they reverse engineer the product by virtue of the structure of the deal, or a hole in the deal, or a hole in the process by which they did due diligence? So they are in effect buying the company without buying it, and thus depriving the investors of a return on their investment. Allowing a strategic to invest in your company is not for the inexperienced. Questions arise from such an investment. Do they have rights that inhibit another buyer at a later date? Competition which improves the exit? Do they ever make a decision, or do they drag you through due diligence just to shop and get educated in your technology? It's something to think about. Now let's discuss the difference between angels and venture capitalists. As you move to the far end of the emerging company technology financing spectrum, angels, venture capitalists, and strategics are all on the same continuum, and while there are similarities, the differences are more striking. We've talked about the similarities being sources of capital, but some are easier to raise capital from than others. The differences, however, span a broad range. First of all, process to vet the opportunity. For VCs, investing is a full-time job. They are hired for their expertise and have capital to hire additional support. I've done this type of work for a few VCs. We will come back to how important preparation is, but the overall message comes from my and maybe your mother's and the Boy Scouts message in that you only get one chance to make a first impression and be prepared before you start talking to an outside investor. The second is the depth of their due diligence. Due diligence is really just doing your homework, but on everything. While your friends and family may get excited about your story, have faith in you, investors don't already know you and want you to back up what you say. Even angels may take your word for it if you sound convincing and are logical, but VCs and other angels, especially angel groups, will not only ask you to back it up with data, facts, resources, but will ask for references and sources and may find their own to independently verify what you've represented. Third, propensity for willingness to accept risk. VCs peg a stage or stages of development in which they invest, as do some, but not all angels. Angels tend to be more flexible as it's their money. VCs are spending their limited's capital, which is determined by their charter. The amount they're willing to invest. Generally, angels invest less as well as earlier than venture capitalists. VCs might invest early, but in the last 20 years, most VCs have shifted to later stage. An example of a relevant range would be individual angels providing between $5,000 and $50,000. Angel groups or funds span a broader range of $150,000 to $1 to $2 million. VCs almost universally want to put to work $10 million or more, but this might be broken up into 2 or 3 rounds. But it's a rare VC that will invest less than $5 million in a first investment. This clearly suggests which types you should consider based on your need in a specific round. Terms they're willing to accept. Angels run the gamut from willing to accept what you put in front of them, especially for a small dollar amount. Angel funds and groups want customary market terms adjusted for the risk of the deal. This last part is similar to what VCs want, which is then modified by competition for the deal. If there's little or no competition, be prepared to receive a very investor-friendly and maybe even a company-unfriendly set of terms. This is where funding and negotiation experience is critical and not for the faint of heart. Lastly, investment and philosophy and approach in making an investment. This is really the lead into the motivations in the next slide. While there is some overlap, you will find VCs and angels very different and with some rare exceptions. Understanding what a potential investor might do is critical to creating good fit. Too many companies have taken dumb money. Those are investors who don't really understand the risk or are equipped to put money in a high-risk situation, or money from sources with motives contrary to the founders rather than compatible, which puts management and founders on a different side than the investors. Remember the golden rule: he who has the money makes the rules. Angels like to be involved and may invest for reasons ranging from return on investment, making a deal with the possibility of a 10 to 100x return, and while there are many ways to calculate return, that would be a topic for another course. I would define this as a simple multiple of cash out divided by cash invested. They're interested in personal learning how to invest better than their historical experience. Contributing their experience and giving back. Contributing their experience to help a company is terribly important to angels. Being valued for one's experience and advice can be very satisfying to successful individuals. Supporting the local economy, contributing to the building, expansion, and improvement of the local community can be a critical mover. Lastly, the overall experience in belonging to a like-minded group, to the camaraderie of the group activity, can be very rewarding. All these 5 areas apply to why angels have joined my 3 angel groups. Venture capitalists get paid a salary and a bonus, but most importantly, a percentage of the return made by their funds. This is called a carry. They're limited partners, those institutions who provide capital to specific VCs that meet the limited's investment requirements, choose the VC, which aligns with their internal investment objectives, and that relationship locks what the VC's invested. It's a mutual self-selection process. Once a VC closes on a fund, the capital is in, their objective is to put the money to work as quickly as possible. Investors measure their overall return not just as a multiple, but as a function of time. This is one of those other methods of return, in this case, the internal rate of return, or IRR. A VC's ability to continue to work, much like the rest of us, depends upon successful investing, which results in current limited's interest in being part of the next fund, and also attract more money per investor, and more limiteds, creating competition to invest in their fund, and more favorable terms for them. This is not too dissimilar than what you're trying to create in your company. The ultimate objective is the next fund. This results in bigger funds, it results in bigger staffs, larger salary, bonus, and shares, and the ability to put more money into investment and overall play a bigger, more exciting game. This also translates into larger cash compensation packages. Fund 2 is bigger than Fund 1, Fund 3 bigger than Fund 2, and so on. As long as they succeed, you want them aligned with you so they support you in subsequent rounds. Success for investors is ultimately determined by getting their investment and a return on their investment back out of the company. You need to know what your objective is for you and your investors and assure that they are compatible. They will ask early on about your objectives, and if your objective and theirs do not align, they will not move ahead. And that stop might seem sudden and inexplicable. So what exits should you consider as you plan for your business? Well, first, dividends and interest, although this really isn't an exit, but part of other deals. Interest in particular is customarily part of an investment where the market interest rate is accrued and not paid on preferred shares and only paid as part of a liquidation or an exit. Dividends can also be part of the term, but no one invests in a high-risk startup with an expectation of multiples of the investment coming back based upon a dividend rate that typically does not occur without board approval. For both, the company is generally burning cash and should not be using an equity investment to pay cash out in dividends and interest. At the end, these, however, contribute to the overall return upon an exit. An IPO. Since the start of formal venture capital back in the 1960s, this is the standard way in which investors get their money out, in multiples, take the company public. But things have changed dramatically in the last 26 years. This topic could also be a class in itself. But to summarize, valuation is tougher than it used to be. Companies going public with a valuation of less than $300 to $500 million are characterized as microcaps. Very small IPOs with limited liquidity. And that means an opportunity for investors to sell their shares. So they're public and they can't get out. Yet they have the high costs of being a public company. Almost the worst of all worlds for investors. The institutions or investment banks that take companies out are both fewer in number and want opportunities with companies that can demand multiple billion-dollar valuations. They are paid a percentage of the deal, and the work is the same irrespective of the size. While possible, and you should express that you're open to this, going public is not a likely exit in the medical technology space. Acquisition. Acquisition by strategics is the single best way for startups to get to that all-important exit. Acquisition by a strategic needs to be thought of your thought process, business planning from the beginning, meaning factor this into what you need to build, knowing that an acquirer has infrastructure that you don't need to or should not duplicate. Factoring this into your fundraising, while knowing that what they can and cannot do can add value to your company, create attractive levels of competition for your deal, which means favorable pricing for you, and generate competition for an exit before you even need to pitch. Buyback of shares, otherwise called a put or a call, where the investor can force you to repurchase shares with a put, or a call where the company can call them back on a specific price. These are not customary, but they do happen. They're more likely to be part of a deal with friends and family, individual angels, or as part of an investment by a strategic than anything a VC group or an angel group might ask for. Both can negatively affect the acquisition. How do you know you're ready to raise funds from third parties, from those who don't know you, angels, venture capitalists, or strategics? The question I get most often is, do I need a plan? The answer is emphatically yes. But the plan you draft first is not for anyone else, it's for you. You should want to know first whether there's truly an opportunity you want to put your heart, soul, money, and all your spare time into. Second, you want to be convinced yourself, because if you're not convinced, you won't convince anyone else. This will also convince those that you want to and need to bring into the company, not just employees, but vendors, business partners, consultants, and advisors. The plan you provide to potential investors should be a subset of this, cleaned up and perhaps sanitized from all the sausage making and anything that might be too sensitive or confidential. It's partially a selling document. The typical components of a business plan appear here. This is a listing. It is not a template. Business plans should capture your story, and while there are some common components to every plan, Your story is unique. Using a fill-in-the-blank template will not provide insights to your business you need and provide the confidence investors need that you've thought through your opportunity and that you are the smartest person in the room regarding your opportunity. A business plan is not just verbiage, not just qualitative, but should be quite quantitative and translate into what you need, such as money and other resources to create, build, expand, and grow your business through the various inflection points or milestones where you simultaneously reduce risk and enhance value. Personally, I always start with a simple outline in a Word document and outline the major categories, whether I'm ready for them or not, and added as many questions that need to be answered as I can, adding to that list by category as often as they occur to me, to members of the team, or God forbid, asked by a potential investor and we don't yet know the answer to. Ultimately, we need to know our business opportunity better than anyone we talk to. This list is not a bad example of a place to start, but I guarantee your startup needs customization. First, let's talk about the type of investor you want to attract and let into your company. Not all investors are equal. Not all investors' money comes with the same value to the company. Your first filter for third party, not friends and family, should be sophisticated investors. They need to have invested in startups before. They understand the risks. They are accredited investors. Behaviorally, they wish to help, but they do not expect to get operational in your business unless specifically asked for this level of help. I have horror stories for each of these and won't burn time now, but unsophisticated, non-accredited investors, such as those you might find in a cattle call like crowdfunding, can be a founder's nightmare. So choosing your investor, assuming you do have a choice because of the interest you've generated, is critical over the long term, but beginning right after your round closes. You may get a sense of a problem potential investor in due diligence, but by that time you might think you don't have a choice. The question then becomes, what do you need to prepare? Under the philosophy that you have just one chance to make a first impression, I believe it's important to prepare all of these to the best of your ability and relative to your stage before contacting any investors. Let's go through these one by one. Executive summary. Developmentally, save this for last as it embodies a high-level, sales-oriented summary of everything below. Ideally, it's one page, 2 sides okay. Use it as a copy provided in advance of a meeting, attached to an email, or as a leave behind after a meeting. Business plan. This is the one for the investors. Now, you might need a confidentiality agreement if the detail you need to provide to persuade a potential investor has not been protected with an IP filing or is a trade secret that needs to be shared. Both of these are highly unlikely. Try to make your plan non-confidential. A detailed budget. This should be developed to get you to the market or through the next milestone and then enough lead time for the next round. I like to budget out to free cash flow break even and to the liquidity of it to know how much I need both now and then all the way to an exit. This also helps the analysis to calculate what my team and I might earn at the end. Prepare boilerplate introduction communications. These include phone call scripts, introductory emails, which are associated with your executive summary, follow up by tickler emails and calls. Being thus prepared will help deliver a level of professionalism not all investors see. A capitalization table. This is both for now, before the round, and then after the round. This explains who owns what percentage of the company and with what category of security. Pitch deck. Non-confidential. This is for the first conversation. This also is a sales pitch. Target a 15-minute presentation. Now, you might get 30 minutes for the first call or Zoom meeting, but leave time for questions. Investors are not satisfied if you do all the talking and they don't have time to ask questions. Then the confidential pitch deck. This is a second and much more detailed pitch and might last 50 to 100 pages and is typically for after a CDA is in place and for after they've given you an indication that they are seriously interested in learning more. This should answer and address many of their due diligence questions. So let's come back to the CDA or the confidentiality agreement. This protects against disclosure of information not yet protected, but critical for investor to know. They do not need to know everything. And if they ask you, you need to know how to answer the question for either condition. Due diligence preparation. We used to call this the data or the war room. This includes all information you might share with a potential investor, tagged as to whether it requires a CDA or not so that you can track that properly. Not being prepared in advance, I guarantee, will slow you down. Investors lose interest and move on. A better company comes along. They're always after the shiny object. Not being prepared indicates that you're not prepared to spend the capital you seek to raise. The objectives always are put the ball back in their court, and that you are always ready for the next interaction and are prepared for that. Lastly, your support team. An investor wants to know who's helping you. Who are the lawyers, the accountants, the advisors, the consultants? They want to know what the quality and the breadth of your team might be. Your value proposition is the basis for absolutely everything. Why the market cares or might care about you, your technology, your company. Why an investor might find your company attractive. Why you and your team should spend any time at all on this. Ultimately, this describes how the returns are commensurate with the risks, and that the risks are understood or at least identified and manageable. The next question I typically get is, should I provide a term sheet or wait for a lead? The answer is sort of yes and yes. You should think through what you want, what you're willing to give up to get what you need. So your set of terms. Where are your lines in the sand and where will you not cross them? Think these through so you not only understand your position, but you know how you'll respond if asked. Again, this speaks to the readiness and professionalism question. The message you send is that you're prepared, you're sophisticated, you know your value, and as a result, they should respect your value and what you have. This is a mating dance. This supports where you push back and when you want to walk. They will test, you will push back. You will test, they will push back. And this iterates throughout the negotiation. You can do this if you have confidence in your ability. You can learn how to do this, or you can hire someone with experience to help. In the beginning, I hired very experienced people to help, and I learned at their feet, read a lot about negotiation and how not to do it, and now I help others. Other things to think about and prepare. What's your negotiation strategy? What's your philosophy? There's a range of how to negotiate. It does help to think this through. Do you take an extreme first cut, hoping to meet in the middle? This is a very American approach to negotiation. Do you factor in throwaway points, counting on giving them away because they're a little ridiculous? Or do you open close to your optimal deal, take principled stances, and hope the other side stays close to where you start? There are many different ways to negotiate. How you respond to each of their responses is all important in how you get to what you need. Models. This is the homework part of your prep. There are deal models. There are previous deals. There are examples of what VCs have done and what they already know. They are in this space and know what is market at all times. But you should know what's been done out there and put your opportunity in that context. You need to know what's going on in the market today and whether today is different compared to recent times or for any unusual any unusual reason. Like there's a stock market bubble burst. There's a virus-related lockdown. There's a war in a significant part of the world, all creating fear. And if so, how temporary is that situation? Could what's going on be a signal to wait for better times and turns? Or is that a signal of things are headed in the wrong direction, and you better grab what you can as fast as you can, because it might be years before things look this good again. I've seen both of these examples in the last 20 years. So what is a good deal? Experience and judgment is necessary here. Customary terms communicate that you know what is acceptable and what reflects the essence of fairness. Terms then need to be customized to the risks and reality of a specific deal. Otherwise, every deal would be identical, but most start with the same common terms. All levels of market competition need to be factored in. This is the relative attractiveness of your business, your differentiation within your market segment. But you also need to factor in competition for capital overall and at your stage of development. Relative to overall fairness, principle is important here. Angels will be much more sympathetic to pushing back on fairness, but VCs hope you wait too long so that you have fewer choices, but the strength of your hand is critical to any negotiation. Pragmatic need. This is all in the context of the level of interest for the deal, and whether there's more demand than there is need for capital. The wasting value or aging of your asset, your intellectual property, access to key people, potential competition, and so on. Time is always your energy. Age of your value proposition, creating competition for the deal, alternate applications for capital, alternate technologies, and so on, all affect getting the deal done. The next question is, and one of the more important questions is, how much should you raise? How to determine the right amount actually is quite simple. First, what not to do. Don't budget for a period of time. Budget instead for levels of accomplishment. Milestones which specifically reduce the risk and enhance value, which should make it easier to raise the next round. So budget to 2 points. Budget until the next major risk reduction value enhancing milestone, and then add enough runway to get the next round done. Then budget further out all the way to free cash flow break even. This puts the current investment into the context of what ultimately is needed to get to the end, self-supporting free cash flow or liquidity event. From this, you and other investors can calculate potential return on their investment. First, qualify potential investors of all relevant types. Ask yourself what qualifies you're looking for in investors, and then use that as a filter. For angels, use accredited status as a first cut. For VCs, having an active fund and having invested in your space is a first filter. Build a database with all relevant fields and track your performance against progress with each individual investor. Use that to help make timely follow-up, track what you've provided, when and to whom. Aggressively use this as a tickler to keep after contacts. I can't tell you how often I hear from companies just once and they never follow up. The squeaky wheel gets the meeting. Getting that first meeting, making initial contact. Your rolling objective is to make sure you get the meeting. But when they are ready, they will agree to kick the tires and start due diligence. Make sure, and this is expressed in the previous slides, you are prepared. You don't want to lose momentum. Entering due diligence. Now, due diligence is a legal term that's used nearly everywhere in business. As I said before, it is about doing your homework and making sure what's been represented to you and what you think is there is in fact there. This is the process to confirm what you say in every single area under discussion. This denotes serious interest from a potential investor once they agree. They have to expend resources to do this, so they are interested. You need to fully understand their process in advance of starting their process, so that their information needs, timing, next steps towards a deal, qualification process is all well understood. Investors are similar, but not identical. Misunderstandings are avoided with clarity on this point before due diligence starts. They will have standard documents they want to verify, such as organizational structure, accounting, intellectual property, etc. But then they will want a long list of information specific to your opportunity. Be prepared. So you get a term sheet for one or more potential investors. This is an expression of serious interest, but there's still a long way to go. Ideally, you get more than one, so that you have competition and choice. Customary terms need to be tailored to the deal. The first or the largest potential investor might want to lead and be the one who negotiates on behalf of all other investors in the round and then syndicates the deal to other investors to fill out the round, but their terms are the ones that those other investors subscribe to. Finishing due diligence takes time and may run all the way to the day you close the deal. Due diligence is not yet done and may continue in a more modest form all the way until the deal closes. Keep this in mind and track what they've asked for and you deliver, and what new items come up along the way. This can be frustrating, but remember, they're testing you every step of the way. Ultimately, there should be a final list of items or punch list that come up during due diligence that need to be resolved before closing. Make sure you keep track. It is a well understood process that VCs will use this as a way to delay the closing to make you more desperate to adjust terms at the last moment. When it comes to drafting legal agreements, hand the detailed term sheet off to attorneys as close to being done with due diligence as possible. This stage is expensive, time-consuming, and you want the terms clear and agreed to in as much detail as possible. There are boilerplates to start with. You'll see some of those referenced at the end, but there's still quite a amount of work customizing it to your particular deal. Syndicating the round. Gather others around you to finish the round. You should plan to do this even if you have a lead. Now, the lead may want to take this over, but I'd parallel path that in case someone drops out. The cardinal rule is that the more interest that you have in the deal, the better the terms, the amounts, and the likelihood of closing there is. It is not unusual for a VC to walk at the closing table. Closing. This may take some time after the documents are done, subject to all sorts of things. The number of investors, the strength of the syndication, their proximity, sophistication, the phase of the moon, lots of other reasons. The big issue is whether the funding must come all at once, or in tranches, or with several closings. As an investor, I want it done all at once. I want the company to have all the capital it needs and be off and running and not distracted with raising money. As a founder, I want to get started as soon as possible, even if it's not in. This can end up being a deal point. Term sheet. These are the key and customary terms for a business arrangement and investment. More in simple business language with an outline level of detail. It's just a start. Don't get too excited. There are quite a few steps to go through before you've got the cash. Continue to parallel path due diligence, negotiation, and terms. The devil is truly in the details. More work now saves huge amounts of time and misunderstanding when time and your attorney's services are very expensive. He who goes first sets the limits on the terms. If the investor offers a pre-money valuation for the company, that sets a ceiling. If the investor offers a pre-money valuation, that sets the floor. You always want to let the other side go first if in fact you can. Greater details in the term sheet saves misunderstanding, legal costs in converting the term sheet to the investment documents, but you need to be familiar with customary terms, meanings, what's available in the marketplace. Like everything else, this has its own language. You'll see some references at the end of this presentation. Let's talk about two primary categories of investments seen now. First, convertible debt agreements. This used to be called a bridge. There is a history of the morphing of bridges into what they are today. Initially, a bridge was designed as a financing between two well-characterized and known points, from where you are right now to a value event and a defined round with investors lined up. They've become, in many cases, a real round without a ready-to-go next step. For timing and execution of this next step then becomes a big risk for investors, and many won't do them anymore, and a lot of time is spent by companies attempting to do a convert and then find out after many months they've got to go ahead and do the round. Converts or bridges changed about 2008 when capital fled, and it was too difficult to negotiate valuation. As to key terms for a convert, the fundamental assumption is that the next round will determine the value, and there's some reason investors of the company don't want to do it now. This puts off today what can be done tomorrow. As I said, this becomes a trap. A discount on a round, typically for a convert, might be 25%. Venture investors value an IRR target of about 35% on average. With the additional risk of an unknown timing, a bridge for 6 to 9 months might be okay if all the other conditions are satisfied. But if it goes longer, if it goes a year and a half or 2 years or 3 years, that 35% return becomes 18, becomes 12, becomes 8. There can be other terms which attempt to mitigate this problem, but they are often attempted as a workaround to an inferior security. And these might include time limits, repayment terms, a cap on valuation, but of course in that case you still have to set the price. This is debt, so there's no board seat included, as are other equity protections. And it should be secured, but rarely is. There can be other covenants, but these are not typical to the covenants you see in commercial lending. Our investment group won't do these anymore. We are strictly interested in equity investments. So in equity investments, I won't go through all the terms on this slide because that could be a class in itself. And you can easily research the key components, but the names really do reflect what they are. Stock purchase agreement provides details about the security. The subscription agreement, the purchase agreement for an individual investor, shareholder rights agreement, voting agreement, management rights letter, again, pretty self-descriptive. Under the next two, the exhibits fitting the representations of the deal. This should be part of the term sheet. The data that's needed in the closing, the information, the tables, the documents that need to be part of the closing should be part of the term sheet, which allows you to gather them, qualify them, make sure that they're what is needed well in advance of closing. And then there are other indemnifications, certifications, written consents. Types of rounds. This is more of an FYI since it does come up, but the letter of a round is less important than it used to be about 20 years ago. A letter round indicated a specific stage in those days. Since then, the market's become much more complex. Too many companies have partially funded rounds, not reducing risk enough for a next full round. Stacked converts together, experienced down rounds, restarts, and so on. But the type of round should express a few things: how you value what you have and where you are in development, how much risk is reduced and the value is enhanced to get to the milestone and the next round, and lastly, how this looks in the context of the money needed to ultimately get to free cash flow break even or that must sought after liquidity event. A seed round is typically just for founders, friends, and family, those who know you, buy the dream, and less about the money and more about the faith. The valuation, that pre-money valuation, should be very low since there is so much risk. This round is typically done in common stock. The preferred A is where the first arm's length investors come in. This is all about milestones, establishing team credibility, decreasing risk. Doing this well makes the next round and all subsequent rounds possible. Preferred stock is superior to common and has customizable rights for investors and used in outside rounds. With each subsequent round closer to commercialization and an exit, the preferred stock takes on an additional letter. But as I said, preferred B, C, D, and E designations don't mean what they used to. However, each round should decrease the risk and increase value and build credibility for the team and value for the company. This supports a step up in value. Otherwise, your best outcome is a down round. This also should create competition in making an investment so the round is at an increasing value of more than the last round. That is expanding the balloon. It's not a zero-sum game. Lastly, there are key questions only a founder can answer. Do you want an exit? Are you building a company that you want to run forever, or is this a project with an exit or return so that you can move on to the next challenge or take your gains and retire? What's your timing? Is this supported by your plan and budget? Are you internally consistent? All this determines what kind of investor you want and who will be attracted to you. This allows both parties to align expectations, structure the investment to match exit goals. The second question is, do you have to have control? Investors, or the smart ones, don't care if the value is appropriate to the risk. And as long as you deliver as promised and stay ahead of surprises, and there will be surprises such as product development issues, FDA changes in processes and approval, reimbursement, intellectual property conflicts, sudden personnel changes, new and anticipated competition. It's a long list of what could surprise you and your investors. How you handle it determines whether they stay with you. Incubators, accelerators, and some investors who are also operators may require that they have control with their investment and control when you have your investment and what your exit looks like. Are you willing to accept that in exchange for capital? That's worth thinking about in advance. Third, what role do you want long term? As the company evolves, what role can you create value in that satisfies you? As a founder, you can have your choice. But it's not yours without demonstrating competence and commitment and being successful. But you get first crack at the opportunity. Planning your career in your startup is important. Not everybody gets to be CEO all the way to the liquidity event. Have you assembled the best team possible, which creates an opportunity for success is question number 4. The best team may not be your friends, your buddies, may not even be those you start with, or even people you already know or can reach easily. There's an old venture capital adage that says a grade A technology company or product with a C team is likely to fail. A grade C product technology company with an A team will figure out how to succeed despite the odds. Get the best people you possibly can. Your decisions and positions may attract key team members, investors, strategics that helps create success. So as a review of the presentation takeaways, determining the best fit between your company and a potential investor is an important step in leading to a successful funding. Not every investor is right for every venture. Raising capital takes more time and preparation than anyone considers. Preparation overall is the key to success before making first contact. And being knowledgeable about your business, market financing conditions, and deal-related terms will put you in a stronger negotiation position with any angel, any venture capitalist, and any strategic. I hope this was helpful.